guys know a little bit about what we're doing, FHA and HUD right now, you submit a deal for underwriting approval. It takes 9 to 10 business days to get your approval back. Okay? 45 to 60-day loan closes. We submitted a deal one Wednesday night, one Wednesday afternoon. Jenny had the thing approved. We're going to docs in 36 hours. Thursday night, we were ready to rock and roll on that. 36-hour approval, guys. We can get these deals done quickly, and we can get them done efficiently so that we can make you guys look good, get your clients the keys, and get rolling on this, all right? 30-day FHA loan closings. Let's dig into this. You have on the first page of your handout today, you have your FHA crib notes. I took out a little bit of the information, so you have to listen to me this morning. Hope you don't mind. Okay. FHA, first and foremost, FHA is for primary residences only. I'm just going to throw that out there. I don't think it's on here, but I want you to keep this in mind. Primary residences only. No second homes, no investors. It's simple. It's for the A-type buyer that we're looking for. They don't have to be first-time home buyers, but you know, if they are, the more the merrier. All right. FHA is fee land only, no leased land. For those agents working out in Palm Springs, keep this in mind. There's a lot of leased land out there. Okay. Fee land only. The husband and wife are applying together. Let's say the husband has some derogatory credit. We run his credit score. The credit score is a little bit low, or he has some tax liens on there that they can't pay off. Whatever the reason is, they don't want to go on the loan together. But the wife can qualify on her own. Okay? Think about this. With FHA, it's the only program that requires that you count spousal debt against their debt-to-income ratios. Okay? So even though the husband's not going on the loan, you're not counting his income, you have to count his debt. Okay? So that's something to think about. What we try to do is get the credit score up so they'll qualify together and we can use the total household income for debt-to-income ratios. Okay? Next one. Debt-to-income ratio, the DTI on here, that's debt-to-income ratio. It's what we look at in approving people for how much they can afford. Somebody comes in and says, you know, I want a $250,000 house. I say, you know, well, you get $165,000 to work with. That's our debt-to-income ratios. Guidelines are typically 43% on the debt-to-income ratios. FHA likes to keep them under 50%. That's your first point there. And we've gotten them approved up to 62%. 62%. Okay? The only way we can really do that is if they have good credit scores, okay, or lots of money in the bank. If they have heavy assets, they have good money in the bank, they have good credit scores, these are called compensating factors. We can kind of exceed those guidelines sometimes, but what we like to do is try to keep it under about 50%. But we can work with those debt-to-income ratios on a case-by-case basis and get them approved. FHA is a full documentation program. Full doc. If you flip back in your packet a little bit, should be right after the free appraisal flyer that I'm sending out to you guys. You come to a sheet that looks like this. There's a required documentation on it. It's a whole list of information that we put out there for you. I gave you a copy of this so you can erase. Yeah, it's going to be on the back for some people. It's going to be a single flyer. It should be on the back of the appraisal flyer or just behind it. Okay? Some packets are two-sided. I didn't want to kill as many trees. Okay? If you look through here, it kind of breaks it up. Salary borrowers, self-employed, retired borrowers. These are the different things that we need to get these types of people approved, documentation that we need. Okay? Keep this with you. Your clients will ask you about this. 2 years tax returns. Right now, it's 06 and 07. W-2s if they're salaried borrowers. 2 months bank statements, social security card, driver's license. This will just get us started. Sometimes we ask for some other things, but these are the core things that we need. Okay, so hang on to that. Full documentation. Okay. In Riverside County, I think you guys heard when the government first increased the conforming loan limits. You guys heard, oh, 729. We can go up to 729 in California. $729,000 would be the conforming loan limit. Well, in Riverside County, because it's based on a median income sliding scale, we can go up to $500,000 for 1 and 2 units in Riverside County. $500,000. So it's up from 417. It's now $500,000. And it depends on the county. So if you've got a deal in Orange County or you know in LA, it could change accordingly. Do most of you guys do business here locally? Yeah. Yeah, refer out that other stuff. Just focus on this stuff, all right? 1 to 2 units. 1 to 2 units. They are permitted. They are allowed, and you can do those up to 500,000. 3 and 4 unit properties are allowed. You can do an FHA loan on a 3 to a 4 unit place, a triplex. Okay, as long as the buyer is occupying one of the units. Okay, so they can rent out the other 3 if they're buying a 4 unit property, and they can live in one, and we can give them rental income to offset it. Okay, I don't have a spot for this, but for the 3 units, you can go anywhere from a minimum of 3 units to $461,000 up to $1.1 million. So if you have a 3, right on the back, your questions, I'll do questions at the end, please. You can go up to $1.1 million on a triplex if they qualify. And for a 4-plex, the minimum you can go up to is $697 and 1.4. Now again, we're going to double check on those on a case-by-case basis for the county. Give me a call and we can research that.